Hello, hello, and welcome to Losers Become Winners, February 8th. Alphas lead with XLE at 60%. There it is, 60% for XLE. Now, what's really cool about this is that this ode is 609. We're at 259. We have some nice, strong potential down below. That will only put us out $350 short of retiring this loss leader to the winner circle and taking it off the loss leaders list. So that's really good. And what we're waiting for is this. Let me move this out of the way. What we're waiting for is price close above the third ratio. We're risking 1 unit for 3 to 1. That's the high old anticipation. So we close above here, 45.53. We are then going to be looking for this pattern. Higher, low, lower low, higher low, and that then becomes the new exit. That is what we're looking for. Once this crosses the third ratio, it has to close above the third ratio for that to happen. That concludes that discussion there. So let's go on now to American Express. And American Express is running here. And American Express. Now, did American Express close above the 128.25? No, it did not. It came out at 127.99. It's 26 cents short. But once it closes in here tomorrow, the anticipation is if it closes here tomorrow, and we have some nice good up indicators, it closes here, again, we're going to be looking for that down, up, down. This is right there. Look, here's the pattern right there. Higher, high, lower, higher, low, lower, low, higher, low. There it is. That is the pattern we're looking for once we cross into the third, above the third ratio. That becomes the new exit. And that signifies as being a support for just a short-term support. All right. So that said, let's go on now to see where we stand. American Express is sitting at 54%. Also, too, recall, we are going to initiate the 100 ROI rule. So 100 ROI, we hit 100 ROI, we're going to take money off the table before someone else does and reduce our ode. Okay, that takes us now over to Nike. And here at Nike, look, Nike did close. Nike closed above the third ratio. It qualifies. Once that rule is initiated, it's done. So put that way out of the way. So here we are. We're looking for this dip. And I even put the rectangles in to pop there. So we're looking for this action to move our stop from here to there. That is the next anticipation. Now, what is this line? Review. This had a low of 130. And what I said about the portfolio managers. This is why did the price stop right here? Look at that. A nice downtrend, a gap down, and then boom. Buyers rushed in. Now, 70% of the market is controlled by the institutions. So they're looking at buying here at 130, and that's where they buy their dip. And then they're looking for a 20% return. So they're looking for this 130, and that comes out to what? 156. This, I put this line here to just anticipate the future. Let's see if the price reaches the 155, 156, and see what it does. And if the portfolio managers are going to prove me right or prove me wrong. I have a high probability they're going to prove me right. Now, do they take exactly at 20%? No, they do not. That all depends on their algorithm and their analysis. And say, hey, we got a 15% return. We don't see any more up. We don't see any more up potential. Grab the money, get off the table. Trading is like a poker game. The money comes in. You add all kinds of money here. So money comes in here, and when it gets full and gets very, very heavy, then the portfolio managers start taking it off the table. Why? They got to produce cash. Remember this. When the market gets overheated, when the market gets very high, portfolio managers need to produce cash for 3, reasons. One, the pension checks have to go out at the end of the month, hitting the first of the month. Second, they got to by producing cash and going and claiming profit, they now have performance. And the third, which is very self-centered to them, but that's business, they earn their bonus. If they produce that, pulling that profit off the table and able to return it back to their investors, the investors in turn reward them with bonuses. That's what they're looking for. So understand that's what that line in the sand is all about right there with Nike and anyone else. Anytime we see these little bubbles, we're going to start drawing in these lines. So let's go on down and see where Bank of America is at. So Bank of America, oh look, Bank of America does have a low here. And we're going to go ahead and put ourselves a portfolio manager. So $129. So at $29.50, the low was $29.57. Well, the low for $20.57. I rounded off $29. There's the 20% return that they're anticipating. Look for a sell-off around $34.80. So I'm going to draw a line somewhere around 34, right there. Look at our ratio. Our third ratio is 34.90. And the portfolio managers are going to be looking to getting out somewhere around here, around 34.80. Around that area, they're going to be looking to getting out. All right. So now we know portfolio managers are getting out. We have a nice uptrend. They're going to grab that profit off the table. We are going to get past our third ratio. We're going to be looking for our up, down, right there. There's the pattern again. Let me do it one more time for instruction purposes only. Higher low. I mean, higher low, lower low, higher low. And it could be 1 penny. It doesn't matter as long as it meets their criteria. And then your stop is the low of the lines. So that's what we're looking for here. We're going to be looking for this for Bank of America and anyone else who crosses the third ratio. They got to cross that third ratio. All right, going on now to TJ Maxx. And TJ Maxx is right here. And on TJ Maxx, we did have an error here. I want to point that again. We got into a nice position right here in TJ Maxx. We were doing quite nicely, and I got stopped out. Why? Because I needed to put the stop at 63.40, and I ended up putting the stop at 63.40.00. The decimal point went in the wrong spot. The computer saw it. Boom, took me out, and it was a $90 loss. So go back and you can see that video in the past. Okay, that takes us now to the last loss leader, and that is Mr. Buffett. And look, we're getting very close to that. We're getting very close to that out point. We have a low of 226. Let's go ahead and do that number. See where the portfolio managers might be gunning for this. 271. So they're looking for 271 way up here. Will they get it? Don't know. We'll see. I mean, the market is working its way up. Now, remember, I also mentioned too, it's not written in stone. Every management company will do differently on making their decision of getting in and out of this. That said, that takes us now over to the last and final discussion for today, and that is the binary option world. Not doing too hot over here, and that is because 1 minute volatility. I did do some trades where I did the hipper. There's the hipper right there. There's a beautiful hipper, and I said, okay, if you touch that, I'm going to go and do puts. And if it touches the bottom, I'm going to do calls. That strategy did not do well in the 1 minute time frame. It might do better otherwise. Did also too. Oh my goodness, we're out of time. You know what? Come back tomorrow and we'll do a little bit more time on binary options. And I thank you very much for stopping by and checking it out at Losers Become Winners. Bye-bye.